Raymond, thank you so much for joining us here at SuperReturn International. What key strategies would you say you're employing in this very tricky environment we find ourselves in at the start of 2020?
First of all, we are all operating in an environment where we are late cycle and the level of valuation levels in the marketplace are relatively high. So first you need to be disciplined, very disciplined in what you do. Second, you need to know what you're looking for in terms of deals and where do you think you're going to find value and robust risk-reward propositions in the current environment. For us, this translates into focusing on bilateral transactions. Out of the, over the past 15 months, more than 80% of the deals that we've done have been bilateral. We like bilateral deals because unless you make a mistake, you're not going to overpay. And more importantly, you're going to have all of the latitude that you need in order to build conviction, which is very important when the levels of valuations are high. So those are better diligence assets. In terms of types of businesses, we look for market segments which have some form of structural growth. We look for market segments which are recession resistant, because obviously there's a high probability or significant probability that over the next 5 years there's some form of economic slowdown. And very importantly, we look for segments which are very fragmented. So hopefully the value creation thesis is going to be you have a bit of cushion getting in, you've been in a bilateral transaction, you've built a lot of conviction, and you benefit from organic growth and consolidation, whereby over time, through tuck-ins, you average down your multiple, your entry multiple, you create more cushion, you buy with synergies and economies of scale, and that gives a risk-reward which is balanced and which, if the economy starts to slow down, is going to continue to produce returns which make sense.
Raymond, I'd like to ask you about your strategic minority partnership with Blackstone. Tell me a bit about that.
First of all, we're incredibly happy and honored, frankly, that Blackstone decided to invest in our firm. It's an enormous vote of confidence for the team, the strategy, and the institutionalization of the firm. We went to seek for a minority partner because I believe that in the world we're in today, if you want to build a business over the long term, you need to have a capital base. So we went to seek for long-term capital, which is why we talked to Blackstone and some other firms. We decided to partner with Blackstone because in addition to the capital, they provide us with strategic benefits that are really, really important, both on our portfolio companies through their procurement program, but also any type of other strategic benefits. It's a firm which obviously manages $550 billion of assets, considerable degree of experience in the asset classes which are new to us, which we're developing, which are credit and real estate. And fundamentally, any issue that we may have, anything that we have never seen, there's a good chance that somewhere, because of their accumulated experience, because of their size, Blackstone has had to tackle with that issue. And for us, we see this as an accelerator of our business. So, it has been a tremendous partnership, and again, we're very, very happy with it.
You obviously see it as a great fit. Stephen Schwartzman today said at this conference it's crucial to have the best teams. People at the end of the day are your scarcest resource. So you obviously see it as a good team effort and a collaborative approach.
Well, in his book he says you need to hire 10s. Hopefully we are 10 in their view. They've been, when you look at their investment record in terms of minority stakes, they've been very, very picky. And so, for us, again, it's a way to get stronger, it's a way to get better, and it's the way to, get fitter faster, if I borrow an expression from one of my portfolio company's CEOs.
So talking about companies that you're involved with, there's been lots of discussions this week about how to exit and IPOs. Could you tell me of a couple of examples of where that's gone well for you recently?
Sure. Well, the best example, which has been an incredible success, which I know doesn't happen very often, is unlikely to happen to me again in my career, has been the IPO of Chewy that we did on the New York Stock Exchange in June of last year. Chewy is an online e-commerce company that is growing incredibly fast. That is, one of the very, very few examples in e-commerce in the US and worldwide where a newcomer, a new startup has basically started to, has not only disrupted the category, but beaten Amazon at its own game. Chewy is a company that we acquired 2.5 years ago. We did an IPO on the New York Stock Exchange mid-June of last year. The IPO was 16.5 times oversubscribed. An incredibly high quality investor base. and this has been a great success. Unlike Lyft, Uber, and Pinterest and others, and not Pinterest but Peloton and others, the Chewy stock price is today much higher than what it was in the IPO. So it has been so far at least a success for us, a success for the management team, and a success for the institutional investors as well.
So a success story there. Where do you see the greatest opportunities lying now as we go forward?
Well, it's difficult to single out, one single opportunity, obviously. For us, we operate across Europe and the United States. We operate across 5 verticals. And the reality is that, you see opportunity both in Europe and in the US, and you see opportunities across the 5 verticals. If you focus on, the type of principles, type of deal, type of businesses that I've laid out, what I can give you as an example of some industries and some segments that we've been in over the past, 2 years. Waste management, IT services, vet clinics, security services, media and cable. So very diverse, but each one of those and each one of those specific opportunities, fits the boxes that I've explained earlier. You need to go and dig those out. You need to understand the industries and the industry segments very well, and focus your time on where you think you're going to find value and where you think you're going to have an opportunity to invest.
Raymond, thank you so much for sharing your thoughts. Great to talk to you.
Thank you. Very nice talking to you as well.